Welcome to the Training and Advisory Services TAS online course. Our thrust for this particular course is going to be International Accounting Standard Number 1, Presentation of Financial Statements. The objective of IS1. It is a foundation standard that explains basic accounting and financial reporting principles and the style of presentation. IS1 sets out the overall requirements for financial statements, including how they should be structured, the minimum requirements for their content, and overriding concepts such as going concern, the accrual basis of accounting, and the current or non-current assets or non-current distinction rather. The standard requires a complete set of financial statements to comprise a statement of financial position, a statement of profit or loss and other comprehensive income, a statement of changes in equity, and a statement of cash flows. The overall considerations of IAS1 contribute to the qualitative characteristics of the framework. For example, the comparative information clearly relates to comparability, and materiality is an indicator of relevance. We will now look at some of the overall considerations of IAS1 and what they mean. Fair presentation and compliance with IFRS. Financial statements are to be free from bias and present fairly the effects of events and transactions. Going concern. The financial statements are prepared on a going concern basis or otherwise on a liquidation basis, which should be disclosed, and the measurements of the elements of the financial statements may differ from the going concern assumption. When the accrual basis of accounting is used, an entity recognizes items as assets, liabilities, equity, income, and expenses, the elements of financial statements, when they satisfy the definitions and recognition for those elements is outlined in the framework. In terms of consistency of presentation, the presentation and classification of items in the financial statements shall be retained from one period to the next unless a change is justified either by a change in circumstances or a requirement of a new International Financial Reporting Standard, IFRS. Materiality and aggregation. Each material class of similar items must be presented separately in the financial statement. Dissimilar items may be aggregated only if they are individually immaterial. However, information should not be obscured by aggregating or by providing immaterial information. Materiality considerations apply to all parts of the financial statement, and even when a standard requires specific disclosure, materiality considerations do apply. IAS1 does not permit the set-off of income against expenses, nor does it allow set-off of expenses against liabilities for faithful representation and comparability. In terms of comparative information, IAS1 requires comparative information to be disclosed in respect of the previous period for all amounts reported in the financial statements, both on the face of the financial statements and in the notes, unless another standard requires otherwise. In terms of compliance with IFRS, an entity shall make an explicit and unreserved statement of compliance with IFRS in the notes, and an entity shall not describe financial statements as complying with IFRS unless they comply with all the requirements of IFRS. The complete set of financial statements. As outlined earlier, the following comprise the complete set of financial statements. A statement of financial position, which shows the assets, liabilities, and equity of a company. The statement of profit or loss and other comprehensive income, which details the income and expenses. The statement of changes in equity, which covers changes in equity. The statement of cash flows, and the notes, which are significant accounting policies or other explanatory notes. IAS1 requires the individual components of the financial statements to be presented with equal prominence in an entity's complete set of financial statements. Let us look at the statement of financial position. This will assist users in assessing liquidity, that is, measurement of the of the ease with which an individual or company can meet their financial obligations with the liquid assets available to them, and solvency, that is, the ability of a company to meet its long-term financial obligations. Solvency is essential to staying in business, as it asserts a company's ability to continue operations into the foreseeable future. The items should be arranged in order of liquidity for both current assets and non-current assets. ISO requires that both assets and liabilities should be classified separately as current and non-current. And for most businesses, it will be appropriate to identify this classification with reference to their operating cycle. Let us look at an illustration of current asset classification. An entity supplies seasoned timber to furniture manufacturers. The operating cycle is clearly defined and timber is matured over a 3 to 5 year period. Now, the cost of the timber inventories would be classified as a current asset as they are realized within the operating cycle. The entity should disclose the amount of inventories to be realized more than 12 months after the reporting period. The following is just an example of current assets and dependent on the operations of each applicable business. Remember, the current assets as well as the non-current assets have to be ordered in the order of liquidity.